This is Investing Ideas by ValueInvestAsia.com.
Let's go back to Berkshire. We talked about the first two major part of Berkshire, which is its non-insurance business and also its equity holdings. There are some smaller portions such as their business ownership with other parties. This is not a big part of Berkshire, but it's quite a new approach that Berkshire is trying out. Why don't you share a little bit about that? What's that about?
So I think the first big business ownership with other parties started in the financial crisis. There is another company, I'm not sure if you're familiar with, people call it a mini Berkshire called Lucadia last time. Lucadia is a mini Berkshire Hathaway, a conglomerate. During the financial crisis, they launched this business and they get 50% funding from Berkshire Hathaway. Lucadia does all the work, Berkshire put in the money, and they share the profit. And that company is called Berkshire. Yeah, so now Berkshire owns 50% of Berkshire and Lucadia owns 50% of Berkshire.
Okay.
The other two are smaller companies, one electrical transmission company and a pilot testing company. So these three forms the joint ownership with other parties, plus a very big chunk is actually Kraft Heinz. So Kraft Heinz comes about when Berkshire initially bought a partial ownership in Heinz, and then 3G Capital came about to borrow money from Berkshire and combine Kraft and Heinz together into Kraft Heinz. And Berkshire now owns a portion of Kraft Heinz, but because they control Kraft Heinz, so they could not account for it as a publicly listed company. They account for it in equity accounting. So, for example, I think most of us knows that Kraft Heinz did not do well over the past many years. And one thing is to do with the general move away from branded products and also Kraft Heinz having its own operational issue. So, for example, if you look at the split of the value of this group of companies, Kraft Heinz is listed at about 12 billion on the balance sheet, but at the market value is about 10.5 billion. The other three jointly owned companies combined together about 0.7 billion in operating income. If I place a 15 times P, then this group of business, these three businesses would be worth about 10 billion. Combine these two, this is just 20 billion worth of investments or the value of Berkshire Hathaway. If we compare this briefly with the collection of equities that is worth about $277 billion, you realize that it's actually really not a very important part of the valuation of Berkshire Hathaway.
Okay, fair enough. It's still good to understand this part of Berkshire, but of course, at the moment, it's not a very big business for them. Another big part of their business, of course, is their insurance business. But before that, Berkshire is famous to in having a very strong balance sheet, and they constantly talk about that they have enough capital reserve in case of any black swan event, so that they can pay out for their insurance. Why don't you talk a little bit about that? How did they manage to maintain this cash buffer? What are they doing with this cash buffer? And why is it so important for Berkshire?
So I think in terms of paying for catastrophe, Buffett has stated in the 2008 letter that of the 100, in 2008 they have about 112 billion, in 2009 they have 127 billion. That in 2008, that 112 billion, only 20 billion is kept aside for emergency. He called it external calamities, which means that the other 90 billion is available for him to buy anything he wants. So this 90 billion is now currently invested at very, very low interest rate return. So the low interest rate environment that we are in right now is bad for Berkshire in a few ways. Firstly, they earn very little on the cash balance. That's apparent. But the real issue comes when the low interest rate causes a lot of people to issue cheap debt that finance a lot of private equity firms' purchase of good companies or decent companies at very high multiples. These are the same people who the same company that might be sold to Berkshire at say 15 times PE will now prefer to sell to this private equity firm at say 25 times PE, which Buffett is not willing to pay up for. So if interest rate stays low, private equity firms gets a lot of liquidity, Buffett or Berkshire is not able to deploy its capital to buy good businesses at a fair price, which gives them their other alternative, which is to buy, like what we said just now, to buy equities in the open market, which is one of the things they did was to buy Apple a few years back. The other thing is to allow this money to be redeployed into the capital intensive business to earn decent return on incremental capital. And the last thing would be for each individual subsidiaries to do this thing they call bolt-on acquisition, to buy companies that is either in the same level, their supplier or their customer, and they form a bigger company. Yeah. So these are the only three sources of cash that can be used, which is to buy companies whole, buy individual stocks, to do more capital expenditure, and within capital expenditure, the other way is for the individual companies to do bolt-on acquisition to grow their stability of their business or to grow their business through acquisition. So that's the only four uses of cash. And Berkshire has been criticized again and again for not deploying their cash. I am personally quite comfortable having the cash not being deployed. Because if I own 100% of Berkshire as my portfolio, if I do that, I feel very comfortable that a large portion of my portfolio is essentially balanced, because that makes up about 20% of my total value of Berkshire Hathaway. Yeah. So I'm happy for Buffett to do the asset allocation for me for free.
You talk about the different way that Berkshire can allocate their capital. But one thing that has been missing in Berkshire has always been private equity or VC, like venture capital. Why do you think that Berkshire has always stayed away from these two asset class, given that their capital doesn't need to be used and can be deployed for a very, very long term? And in that sense, wouldn't private equity or venture capital be almost like a perfect type of asset that they venture into?
I would argue that Berkshire Hathaway is one of the best private equity firm in the world, but they use private money to buy equity of other business without a lot of leverage.
Okay.
Yeah, so this is actually the essence of private equity, just simply money that's not public, right? But in terms of private equity as a business, I don't think they want to get into it, because I think private equity as a business is mostly a fee business, fee generating business, and it is not about buying good companies. Whereas VC is very different. VC, you are trying to buy, say, 10 companies with 2 that do very well, 5 that does okay, and 3 that go bust. And that is definitely not Berkshire's thinking and model from the outset. So I think VC not being part of their business is quite natural, and they have been doing a whole acquisition of business and holding them for the longest time since the takeover of Berkshire Hathaway by Warren Buffett.
Yep.
Yeah.
Okay, fair enough. Let's dive in more detail into their main business, which is the insurance business. Why is their insurance business so special? Apart from, you say that they have very strong underwriting discipline, right? But just looking at the way that they have grown their insurance business has been quite fantastic compared to a lot of other insurance companies in the same field. How has Berkshire really been able to achieve that?
Berkshire has been able to achieve growth in its, I would just call it float, mostly through a few areas. One is through its original businesses like Geico, earning market share from people buying more car insurance. Those are pretty easy to understand. The other type of insurance that they actually sell is this thing called reinsurance. Basically, Berkshire Hathaway is the insurance company of insurance company. So imagine a classic case would be asbestos liabilities. So imagine another insurance company having sold this sort of health insurance to their customers. And this payout could be in the next 30 years, 50 years, where we don't know what is the final payout of this group of people who are going to claim. But a lesser company may not have the cash flow or the financial strength to last till then, to have enough reserve to last till then. So what they do is they will package all these liabilities together and will pass it to Berkshire Hathaway for cash upfront. Berkshire Hathaway would take cash from them upfront to say that, okay, in the next 30 years, should this thing happen, I will pay out for you. So now the great thing is Berkshire Hathaway got cash from their insuree, and they don't have to pay out this cash for a long time. Even Berkshire's ability to underwrite very well, they also make money from the people who pass them these liabilities. For the people who pass them these liabilities, they are happy because now their balance sheet is freed up to write more insurance. And the regulators are happy because they say that, oh, who insured your insurance contract? Berkshire Hathaway. Berkshire Hathaway has such a good credit rating. Sure, go on and write more contracts. So that's how reinsurance works. So it is really Berkshire leveraging its financial strength to, I wouldn't say extort, but to get very good rates from other companies which has lesser financial strength. So that's one of the major way they grew. They grew through reinsurance contract. They grow through underwriting more within the same market space. And the last thing is, very often Berkshire Hathaway's insurance subsidiaries would do their own bolt-on acquisition. When they do their own bolt-on acquisition, they would buy companies that is similar to what they are doing, and have the same culture of underwriting profitably. It could be an old owner who wants to retire. It could be someone who wants to combine efforts with Berkshire. It is rarely the case where they buy the portfolio and they liquidate it. They actually just buy the company and let it run as it is, which to me sounds like private equity again. Yeah. But so they are not trying to squeeze more, say, synergies out of any acquisition, but just to buy good companies at decent price. And the seller is happy because they can continue to do what they like. And Berkshire is happy because they have a new stream of income, new float, and yet don't have to have more management work to be done. So this is a win-win for them all.
You are almost describing like the perfect business, right? And from the way you explain it, it is quite straightforward and it's not very difficult to understand. But what is the core competitive advantage of Berkshire? Why are they one of the only ones that is able to create such a machine so perfectly, while others may try and copy but has not really done as well?
I feel that it has to do with what Munger calls a deserved web of trust. He says that this is one of the highest form of human evolution, where a person that is worth to be trusted is being trusted by the person trusting him. So everyone deserves that trust within that framework. And in this sense, General Re's manager, Ajit Jan, Buffett always jokes that if Munger, Ajit, and Buffett falls into the water and they all can't swim, and you have to save one person, save Ajit. And that's what Buffett says. And yeah, you have someone like Ajit who can earn definitely a lot more outside Berkshire Hathaway, choosing to stay in Berkshire Hathaway. Then the question is why? And I would say it's the culture. The culture that is very risk aware and who walk the talk. The culture where there's no big committee breathing down your neck. I don't think very talented people like people to breathe down their neck. A lot of listed companies have to do quarterly reporting, annual reporting. You have analysts who do not know your business well breathing down your neck. You have fund managers breathing down your neck. You spend your time not doing your job, but to make sure these people are happy. Whereas if you are at Berkshire Hathaway, you only have one boss who know your business inside out. And all he asks of you is to underwrite profitably. I would love to work for him if I'm an insurance guy. And now can you imagine any other listed company that can recreate this easily. That sense of trust, that sense of ownership, that sense of liberty when you work for this conglomerate, but yet you have your own independence. All you have to do is send cash up and he will help you invest. So now it absolves you of need to having an investment committee to meet 4 times a year, 8 times a year. You have Berkshire Hathaway investing on your behalf. So I think all these are very unique things that is only in Berkshire. And which is one of the things I like about Berkshire Hathaway is that I think these are cultures. And culture is a thing that is not on the balance sheet. It is not there, but you know it's there. It's the way things are done and how people behave and think. And over time, this culture attribute a lot of value. It create internal controls, and it create value addedness for your shareholder in the super long run. But culture takes decades and decades to build. And I believe the Berkshire Hathaway today already have that culture of being risk aware, of not overpaying, of not breathing down talented managers' neck. And that will outlast Warren Buffett, the human being, which makes Berkshire Hathaway a good long-term investment over, say, the next 30 years till the culture change.
I might want to challenge you on that premise,
sure.
right? On that premise saying that the culture might surpass Buffett in his lifetime. Because a lot of what you talk about, say if you're a talented manager and you want to work for Buffett because he has created this company with this culture, it still ends up that I want to work for him because I'm working for Warren Buffett, right? And let's talk about the succession planning and what will happen to Berkshire in the future when Buffett and Munger is both out of the picture, because Berkshire has always been created with this culture, but at the top sits Buffett. He's almost like the emperor, right, of Berkshire, but a benevolent emperor nonetheless, right? But whenever the emperor leaves, then there's a power vacuum, and people tendency would still, even if they are not, they might be subconsciously aware of this, but they would want someone to fill that void. There will be a power struggle. We've seen it now in Malaysia as well, in Malaysian politics, right? The emperor has not passed away, but they already have a power struggle within. So wouldn't that also happen in Berkshire? Even though today he said that I'm going to pass the CEO position to, say, Ajit, okay, or whoever it might be. But the people down the line, they are there to work for Berkshire, not to work for Ajit, right? Because they are there to work for Buffett. Wouldn't that create tension and break down the culture?
I would agree with your previous slip of a tongue saying that they are there to work for Berkshire.
Okay,
for
explain.
Example, if I'm a talented manager, I would say that I want to work at a place where I get to do my work. And I get to do my work does not mean I get to work for Buffett. I get to work for a place where it does not breathe down my neck. And that, as long as that side of the bargain holds, I think talented manager would stay. If there is a power vacuum, I don't think there will be a power vacuum. Because if you think of it, Buffett over the past 5 to 8 years has done something quite unimaginable. At the operating side, you have Ajit doing all the insurance. You have Greg Abel doing all the non-insurance business. You have Ted and Todd running the portfolio.
Right.
Ted and Todd also sit on many subsidiary boards that requires capital allocation decision. So this 4 of them, this is the big 4. And yet at the same time, the chairmanship will be passed to Howard Buffett, Buffett's son. I am not familiar with Howard Buffett, and I'm not sure how he will behave or what part of the culture thing does he bring. But the most amazing thing is, look at Berkshire Hathaway's board. Berkshire Hathaway's board is filled with directors who have a large part of their net worth in Berkshire Hathaway. Where does Buffett's stock goes to after his death? It goes to the Bill and Melinda Gates Foundation. Essentially, Bill and Melinda Gates Foundation indirectly control the largest part of Berkshire stock in the future, at least in the next 10 to 15, 20 years. Who benefit the most if Berkshire Hathaway continue to be a good company over the long run? the end beneficiaries of Bill and Melinda Gates Foundation. Who is one of the directors on Berkshire Hathaway board? Bill Gates. So with all these pieces in place, I think he has created quite an amazing check and balance where even if Buffett suddenly goes senile, to protect the beneficiaries of the future, I am very sure the board will kick Buffett out. And that is my belief in Berkshire Hathaway. This structure of shareholder being the lead director, a shareholder who is also a lead director, is perfect alignment of interest, which is very rare. But in corporate governance, we call it non-independent director. I have no idea why. But if I'm a director who is sitting there and my beneficiaries are going to benefit from the growth of Berkshire Hathaway, I will do my utmost to protect my assets. Yeah, which is what Buffett has been doing his whole life. 99% of his net worth is in Berkshire Hathaway. Yeah.
Okay, fascinating thought. Before we end, why don't you share a little bit about how you think of valuation for this company? How do you actually value up this collection of company and assortment of stocks within Berkshire?
Sure. So in my valuation of Berkshire Hathaway, I followed his 2018 valuation method. He cautioned us not to be too caught up in the nitty-bitty details of Berkshire Hathaway. He told us that there's actually just 5 groves in this forest, and don't lose the forest for the trees. The trees would be understanding BNSF, understanding Berkshire Hathaway Energy to very minute details, to understand every single moving parts of Berkshire Hathaway. No, he said that all you have to do is understand that we have 5 groves, and these 5 groves work in tandem. So the first one is the non-insurance control business that we talked about at first. The non-insurance control business makes about $17 billion last year. It has about depreciation of 10 billion. I assume a zero growth capex, which means that this business does not grow at all in the future, and apply a 15 times P, which is, I think, current S&P P is what, 25?
We have to check on that, but it should be in the 20s.
20s, right? So I apply a 15 times P, assuming a zero growth business, and this would bring me to about $221 billion worth of non-insurance control business. The collection of equities as at 31st December 2019 is worth 248 billion. If we sell all this today, we have to incur a federal tax rate of 21%. So I minus this $29 off 248, and I'm ending with $211 thereabout. Yeah. So $200 billion over dollars in collection of equities. And then next we have business ownership with other parties that we talked about, Kraft, Berkshire, and the other 2 companies. Just so we say that it was $20 billion. That's about 3% of my total valuation. The total cash that they own, cash plus cash equivalent like T-bills, is about 128 billion. And then the last part where Buffett in 2008 did not give a clear figure of how to value this business. So what I do is quite simple. I look at the current level of float, which is $129 billion. I assume that this float constantly decline over the next maybe 30, 40, 50 years. So they don't write any new business. It's a dying business. And yet at the same time, they earn their combined ratio is saying 98.5%, which means that for every $100 of underwriting, they will make $1.50. Over the next 30 years, the present value of this stream of underwriting profit will be 14 billion. But mind you, for the past 10, 20, 30, 40 years, Berkshire's float has been growing and growing and growing. My assumption here is going to decline at 3% year after year after year after year. Yep. So this is about $14 billion. If you sum all this up, you get to a total valuation of about 600 over billion dollar. Per share value is about $229. And the last I checked, and the value per share is about $270 thereabout. The last I checked a few nights ago is about $229 sold on NYSE. So you are buying this company that is very safe at a 15% discount to value. Yeah. So the underlying value of Berkshire Hathaway should grow at between 8 to 10% per annum over the longer period. You are buying it at 15% discount, so I think you should be able to get 8 to 12% over the long run while sleeping very, very well. Yeah. Is it going to be the best stock to own? No. Is it going to be the high flyer? No. Is it going to be the worst stock over the 10 years, next 10 years? Definitely not. Is it going to be S&P over 10 years? I think by a small margin, yes. Is it going to be
Okay.
S&P over the 10 years by a small margin at lower volatility? I think yes. So that's my main thesis of holding Berkshire Hathaway. It's a very comfortable thing to own, but it's not going to make you super rich. You're not going to get a 10 bagger out of this. That you have to look for surging. Yeah, but this is something very comfortable. And I think if someone wants US exposure, you want to own a group of very stable companies, Berkshire Hathaway I think is a very good choice.
Okay.
Yeah.
When I think during one of their Berkshire annual meeting, Buffett actually have this 10-year bet with a fund manager, right? If you remember that if this fund manager bet 10 fund of funds, and Berkshire and Buffett basically say that regardless of whatever funds you choose, the S&P 500 will most likely outperform those funds, those basket funds. And after 10 years, he was proven right? The S&P was so much higher in return over the funds of funds. And similarly, in the case of Berkshire itself, the Berkshire stock itself, when we compare it to the past 10 years of S&P returns, the S&P 500 has actually outperformed Berkshire as a stock, right?
Yes.
And you also mentioned that the non-insurance business, Berkshire has reached a point where it's no longer looking for super high growth and super high return businesses, but just stable businesses that will give him reasonable return that is more than what he needs to pay out in the float. So in that sense, hasn't Berkshire really reached the point where it might be just better if we just buy S&P 500, given that S&P 500 now is still predominantly very focused on a lot of the tech sector stock, which are growing, upwards of 20% a year still. Whereas Berkshire, the only tech stock that they have is Apple, which is one of the slowest growing tech stock in the whole Nasdaq, right? So what's your view on that? Why choose Berkshire?
Well, my view is that the underperformance can be explained by investors' preference. Since 2000, now it's 2020, since 2010, it is just right after the financial crisis. Right after the financial crisis, it is not the safe big companies that grow well. It is the riskiest part of your Russell 2000 that grow very well, the riskiest part. And then as capital rotate into other stocks, it is your tech stock that does very well. Tech stock that may or may not be earning any profit or cash flow, but tech stock that can earn people's imagination. Berkshire Hathaway as a company has underperformed has underperformed stock indexes over time, a period of time, for many periods in the past. Most apparently would be the dot-com bubble period. Are we in the dot-com bubble? Buffett say we are not. We're not in the bubble territory anywhere. But the underperformance can be explained by people do not want to own something as boring as this and want to own something exciting. If enough people want to own something exciting, the exciting things become more exciting. And then the question is, am I confident in 10 years' time, for example, in 10 years' time, am I confident that S&P will be a lot higher or a lot lower than today? I would say if higher, a bit higher. But by what percentage, I don't know. The reason is not that I think earnings will go down, but I'm not sure if PE applied on my earnings will compress. So if PE goes from say 25 to 15, I lose about almost a third of my capital in terms of PE contraction, which means that going forward for the next 10 years, if PE goes from 25 to 15, my earnings has to grow way more than 30% for me to even get a decent return. So I cannot predict what is the next 10 years return on my S&P 500 index. For Berkshire Hathaway, you can see where the sources of growth are going to come from. and it's going to be about 6 to 10% or 8 to 12% thereabouts. You are not paying extra today for Buffett. You are not paying extra for growth. In all my valuation, I assume that this is a company that's dying. As long as it doesn't die, right, my valuation is overly undervalued. Since you are buying something safe, growing, and you are not going to pay anything for growth, any growth is free gift, then I'm quite confident of getting my 8% to 12% from Berkshire Hathaway compared to, say, maybe 5% to 25% from S&P 500. So from the perspective of me liking to sleep very well at night, I would still prefer to own Berkshire Hathaway over S&P 500 over the next, say, 10 years. Yep.
There's no way of catching you out on your thesis of it.
Right?
Okay, extremely fascinating talk, and it's always interesting to talk to you, Lo Wei. Thank you so much for agreeing to come on our show, and I'm sure that our audience will love your ideas on the full detailed description of what Berkshire Hathaway really is and why it can survive beyond Buffett. Once again, this is Lo Wei. Thank you very much.
Thank you for listening. You can subscribe to our show on Apple Podcast, Google Podcast, Spotify, or wherever you get your podcast. If you are feeling generous, please give us a rating and review as well. This would greatly help other investors find out about our podcast. To access our show notes, please go to valueinvestasia.com/investing ideas and be sure to sign up for our email newsletter for more outstanding content and reports about investing. The show is for entertainment purposes only and should not be taken as investment advice. Please seek professional advice or do your own research when making any investment decision.